Hello, I'm Juliet Schooling-Latter from Fund Calibre, and today I'm talking to Rosemary Banyard, Manager of Downing Unique Opportunities. Rosemary, thank you for joining me.
Pleasure.
Firstly, perhaps you could tell us a little about the fund and the types of companies you invest in.
Yeah, so it's basically a fund that invests in UK equities, both on the main market and on the AIM market, with a market capitalisation of between 150 million and 10 billion, so small and mid-cap in the main. And the fund title, which has the word unique in it's a clue to what I'm looking for, which is unique businesses in terms of being listed in the UK. And these businesses are going to have something about them which enables them to earn above average returns on equity capital. So something that's special to keep the competition out. And that could be a brand, it could be a unique resource, it could be barriers to entry, such as it's very expensive to switch to another provider. It could be that they're the largest provider of a network. It could be that they've got patents or government regulatory permissions, something about them that makes them special.
Thank you. You mentioned brand there. I was wondering how much have intangible assets like brand and good customer retention helped your companies survive throughout lockdown?
Yes. Well, I think definitely a good brand and good customer service are helpful. I think to generalize first, the most important thing that's enabled these companies to survive in lockdown is that they're very conservatively financed. So I've got 31 holdings in the fund, and only 6 of them have any debt at all. The rest have net cash. And so, when you get a sudden downturn like we've had, the fact that you don't have any debt, that you're not beholden to the banks, is very helpful. And indeed, only 2 of the companies in the fund have needed to come and raise equity finance, and in both cases, that was only a 5% placing. So I think that the biggest single thing that's helped these companies survive is the financial structure. And then apart from that, there are examples of companies that have strengthened their position with their brand and their service. An example might be Dunelm, where if you go back 3 years, only 14% of their revenues came from online. At the moment, they are trading with no shops open, and they are trading at 70% of previous revenues. So there's been this massive increase in their demand online for their homewares products, and that is testament to their brand, their range, and their service levels.
Right, and now, thankfully, we have a roadmap out of lockdown. Does this open up more opportunities or ideas for you, companies that perhaps you've sort of steered clear of, but might come out of this stronger?
I would say not especially. When you launch a fund, you have to put a model portfolio into the regulator for approval. And that happened just over a year ago. And the names in the fund now, there are only probably half a dozen, if that were not on that original list. So I've very much stuck to investing in things I intended to anyway. That isn't to say that some of the companies won't benefit from emerging from lockdown. I would say the single biggest factor that will help a few companies in the fund will be a return to some sort of normality for hospitals, both in terms of carrying out non-urgent operations and a recovery in outpatient procedures. because I own certain businesses such as Advanced Medical Solutions, which supplies wound dressings, and Tristel, which supplies disinfectant, amongst other things, to outpatient equipment. And those businesses will do a lot better when hopefully our hospitals get back to normal. But I bought them. I would have bought them anyway because they have very good market positions and lots of growth potential in the medium to long term.
And you mentioned investing in AIM, which is a part of the UK stock market that's performed extremely well over the past year. Are there any companies in this space that you could tell us about?
Yes. So approximately 30% of the fund is invested in AIM companies. I don't have a particular target in mind for that. It's very much a bottom-up stock picking portfolio. So it's what comes wherever it's listed. One example, one of my more recent purchases, which is on AIM, is a company called Ergomed. Which has changed a lot since it listed a few years ago. So it's always had a bedrock of performing clinical trials for drug companies who are having to go through 3 phases of trials to get a drug approved. And it has added in also something called pharmacovigilance, which is where you are doing tests after a drug's been launched, which are safety tests, which are ongoing after the launch. And I've invested in it because these are growing areas. Particularly, they specialise in doing trials and safety trials on cancer drugs, and also what are called orphan drugs. And they also have a unique network which includes carrying out trials in the Middle East and Africa, where a lot of the competitors don't have a setup. So they've got a number of sort of unique aspects to their business and specialisms, which are above average growth areas, and they're very strong in those. And they're building up the portfolio in America.
Interesting, thank you. And could you perhaps tell us a little bit more about the investment case for Games Workshop and Elementis, 2 of your top 10 holdings, I believe?
Yes, that's right. So Games Workshop is a business that I've known since it floated on the stock market, which is probably over 20 years ago. It's probably familiar to a lot of people as a manufacturer and retailer of fantasy war games involving figurines which you collect and you paint, and then tabletop war games that people that particularly young men play, and it's been investing. It's a hugely well invested business. It sells both in physical shops and online. And the people that are involved in it, who get involved in it, it becomes a passion, a hobby. So there's inherent growth in that business just from the keenness of the hobbyists. But they have also dramatically in the last 5 years increased their attempts to exploit their own intellectual property, such that royalty income from licensing out their stories has gone from very small percentage of profits to getting towards 20% of their profits in the last year. And I see genuinely ongoing growth in the hobby with this add-on of the license income continuing to grow over time. They've sliced and diced their intellectual property and their stories up into small parts, so they can license out small parts for a long time. The other one you asked about, Elementis, is rather different. It's a specialty chemical company which had a difficult time because although they make some interesting additives, quite a lot of their additives go into cyclical industries such as paint manufacturing, paper manufacturing, but a number of unique attributes attract me to it. One is that they have the only substantial mine to mine a product called Hectorite in the world. It's in California, and Hectorite is used in, for example, in makeup and nail varnish and lipstick to make these products flow better. So the concept that your nail varnish will actually be applied smoothly is thanks to the Hectorite in it. And so they've got this unique mine and for supply. And they've also added a business which has one of the two leading mines to mine talc in Europe. And talc is used in all sorts of applications, such as making plastics lighter for use in cars. It's interesting because after we bought it, the company had a bid approach from an industry competitor at 130 pence. I was buying it about 80 pence. The shares are around that level, perhaps slightly below. So I think they're well underpinned by the bid, which they rejected. And we should see quite a recovery in some of their end markets over time.
Thank you. Ooh, very interesting. Thank you so much for chatting to me today, Rosemary.
Thank you.
For more information on Downing unique opportunities, please go to fundcalibre.com.